And welcome to ETF Edge, your go-to place for everything ETF related. I'm your host, Bob Pisani. Here we have three of the best names in the business with us today. Jan van Eck from Van Eck Vectors. And of course, we have Tom Lighten, a regular here from ETF Trends. Ben Carlson is also with us from Ritholtz Wealth Management. Tom, I want to start with you. I've been looking at some of the inflow numbers for the year. We potentially have a record year of inflows, although it's a little bit odd because we're talking about $252 billion in inflows. Potentially, that could be a record for the year. But if you really lift up the cover a little bit, you'll see an awful lot of this is because of bond inflows, not equity inflows. What do you think is going on here?
Yeah, absolutely. The great thing, Bob, is investors are spreading the love around all types of ETFs. Yes, as you point out, $117 billion so far in fixed income ETFs. Led by a lot of the corporate bond ETFs. The Fed buying, I think, has helped fuel that along as well. But there's some other areas. There's been a bifurcation in the equity side. People have been moving away from the S&P and moving more towards NASDAQ-related ETFs, like the QQQs have $12 billion in new assets, where the S&P SPY has lost $23 billion. And a couple other things. You point out gold. Gold and commodities-related ETFs have a surprisingly $41 billion in new money coming into ETFs, with finally your favorite area, Bob, inverse and leverage, $16 billion of new money coming into that area so far.
That's hard. It's hard for me to figure out why that would be happening. Jan, you've been watching this for decades as well. Does anything strike you about the inflows this year? I want to talk to you about gold inflows in a minute, but we just put up the list. Vanguard S&P 500, okay, not a lot of surprise there. Investment-grade corporate bonds, I would not have put that on a list 6 months ago for big inflows. Triple Qs, that's the NASDAQ 100, okay, that makes some sense. High-yield corporate, you would have thought like 6 months ago people would have advised against high-yield corporate, and yet look at the money going into these. Can you make sense of all of this for us?
Bob, it's just don't fight the Fed, don't fight the Fed. Every single one of these trades, almost except the triple Qs, is don't fight the Fed. In fact, you'd probably be shocked to see that our biggest inflow ETF year-to-date is our high-yield corporate ETF, the Fallen Angel ETF, with $1.2 billion in inflows. And although the Fed literally has been buying that ETF, they only own 2% of the inflows, so can't thank the Fed for all those inflows. But it makes sense. We're going to have lower for longer and longer, and I think investors have realized that, and they're just chasing that money. And it is a little surprising given the hiccup and the large discounts we had in ETFs in the March April timeframe. So it's great to see that investors, I think, understand what might happen in different fixed income markets and still have embraced fixed income ETFs.
Yeah, and that Fallen Angel ETF has been very popular that you run. That invests in what bonds that used to be investment grade that are now less than investment grade.
That's great. Exactly. They
right?
just get downgraded. Yeah. Quality companies that have what I call a bad hair day and get categorized as junk. And that index is, people chase performance. That strategy is beating high yield benchmarks by 5% year to date. So it's working again.
Yeah. Ben,
and Bob,
you write.
Just to add on to that,
with
earnings going where they are and some of these downgrades, there's a lot of attention to those fallen angels. And it doesn't mean that they're going to have a bad hair day forever. They can come back. And with this strategy, it's a real good strategy for today, because some institutions especially are forced to sell those when people like Jan can come in through their strategy and buy them in at the bottom.
Yeah. Ben, you write one of the best investment blogs on the street. I always find it informative and educational and coherent, which is, that's a compliment, believe me. And they're not always, some of the stuff I read is not always entirely coherent to me. I'm not talking about you, but other people. So highly recommend your blog to anybody who's not familiar with it. I'm wondering what you think of all of this money coming into ETFs. So you're a very broad observer of the market. It seems like low cost and passive is winning out. Is there anything that gives you pause or concerns about this ETF tsunami that we're seeing money keep coming into this sector?
No, I do think that it's on net a positive for investors. Obviously, the fact that the barriers of entry have been taken down makes it easier for people to hop in and out of things. I still keep coming back to the corporate and junk bond stuff. It's just amazing where we are compared to where we were. The LQD corporate bond ETF was down over 20% in March from the peak to trough basis, and now it's up 10% on the year. Junk was down 23%, and now it's flat on the year. Obviously, a lot of that is the Fed, but the fact that they can snap their fingers and make people feel more confident in this stuff, and people just plow in, it's pretty amazing when you think about the fact that this stuff used to be so illiquid and hard to trade for individuals.
Right. Well, you know, Ben, this makes some sense. You mentioned don't fight. It was mentioned before, don't fight the Fed. But to a large extent, the Fed has insulated companies that have high yield, for example, higher risk, from potential losses or defaults. Somebody once described this to me as imagine you've got these aging gazelles, these older companies that have these high yield, they're higher risk out there, and they're with younger companies out there, like younger gazelles. And if you see a lion all of a sudden out there in the form of a recession, there's something that could be eaten here, meaning the older gazelles, the companies that are more at risk. But the Fed has come along and essentially put a fence around the lion. And it made it a lot difficult. It's making it a lot more difficult for companies that may have been weak already to actually default or go under. So does that make some sense to you? I mean, the market is reacting certainly in a somewhat rational way. Or do you think the market is wrong on this call?
I think, to use your analogy, the Fed is basically a big game hunter going after distressed investors because they weren't able to get distressed prices in a lot of ways. And I think that's one of the big differences in all this, is that we didn't have huge blowouts. The spread started blowing out, but as soon as the Fed stepped in, everything came back in. So I think it really may, going forward, change the way people think about risk and how these things will work. And obviously the Fed has pushed people out on the risk curve, too, because treasury rates are so low, and just finding yield anywhere is really tough for people. So I think the way that people look at risk during a crisis could change from all of this.
Yeah, I think you're absolutely right. It's amazing how much the spreads came in once the Fed got involved. I want to move on. Speaking of inflows right here, guys, gold ETF seeing massive inflows. The Spider Gold Trust, this is the biggest gold ETF, the bullion ETF. It's up 33% this year. Now the sixth largest ETF in the United States. Who would have thought, Jan? And you're very involved in this whole business. You have a bunch of ETFs around gold, including the gold miners. But I want to bring up your point from last week. You had a paper out saying gold could go from, it's 1,900 today to about 3,000. What is driving that sentiment? And can you explain to us briefly why you've just turned, or why you've become even more bullish?
Well, look, I think gold competes, I'm oversimplifying here, but gold competes against interest rates. If interest rates are high, gold, which pays basically no interest rate, becomes less attractive. As interest rates vector towards zero, which they are now, then gold's relative appeal grows. It's really that straightforward. Now, what's hard for people to understand, I think, is it's not just the nominal interest rates or the interest rates you see on TV. It's real interest rates. And so real interest rates, as we saw in the inflationary cycles of the 70s, went to -4 or -5%. Just because of the math, you can't get there in a deflationary cycle. So right now, we have negative real rates of about 1%, and maybe they can get to 2%. But negative rates are still good for gold. So that's why we don't think it's going to be a blowout like the 70s, where gold would go up 4 or 5, 6, 7 times in a cycle, but we think rising 2 to 3 times in a cycle is completely reasonable, given that it's clearly in a bull market.
And Jan or Tom or Ben, anyone wants to jump in here, is it fair for me to complain that the gold bugs keep trying to change the argument? It used to be it was good for inflation, and now Jan's making an argument it may be good for deflation too. Am I being boorish by pointing out that it's heads gold wins, tails gold win? I mean, can you really actually claim it's everything?
Yeah, well, I think you need to talk. Go ahead, Ben.
I just want to defend myself really quickly. I'm not always gold bullish. So we became gold bullish in the summer of 2019 when the technicals supported the Fed stimulus. And I will say on the risk side that higher rates will be bad for gold. The gold bull market will end when rates start going higher. Now, the Fed said we're not thinking about raising rates, so we think it's going to be a longer cycle. But that's the risk to the trade. So I'll turn it over.
Yeah, and just to add, we may be in a stagflation environment as well. When you think about the unemployment numbers, the low economic growth, and as Jan mentioned, with low interest rates and the potential for inflation creeping in, that all lines up. There are other stagflationary periods over time where gold has done really, really well.
Yeah. Ben, you've written about gold in the past in your blog. You've noted that gold tends to do better during periods when the dollar is weaker. Yet you've written about gold that the strong dollar is generally not good for gold. And yet this year we've seen a somewhat weaker dollar and gold's also outperformed. So can you sort of explain that, or is the dollar only a small component in what makes gold move? Looks like we're having trouble getting Ben. Anybody want to, jump in? Because Ben had
jump in, Bob. One thing that I think we don't want to overlook is the pure supply and demand aspect of this. World Gold Council does a great job every month of being able to produce real reports about how much gold is being bought out there in the marketplace. It's not just central banks. It's not just individual investors like us. Jewelry demand continues to be strong in emerging market countries, and with that, that's also supporting the price. And ultimately, it's getting more and more expensive to get an ounce of gold out of the ground. And with that increased demand, we're going to continue to see the prices advance as well. So they're the fundamental and economic aspects of it, but definitely demand from an acquisition standpoint.
And Jan, can you address that supply issue that Tom brought up? Because it's obviously a supply-demand thing going on here. Tom said it's more difficult to get gold out. Is it because there's less gold to actually mine, or is it harder to get at? What is it that the supply is getting a little tougher to provide?
There haven't been major discoveries for many years now. That's number one. The amount of gold per ton of dirt is at much lower levels than it used to be. But, I hate to quote my dad, but he used to say, all the gold that's ever been produced is sitting around somewhere. So at the right price, there's always enough supply to drive prices lower. So I tend to focus more on the relative attractiveness rather than the supply demand. But, some of the factors that Tom mentioned are no doubt important.
Yeah. And one final thing to add there, Bob, if I could, the importance between investing in the spot gold price itself and then the miners, and then the difference between the miners. The large miners that we see in GDX are quite different than the junior miners. And during times when gold's advancing, there's a lot of pressure on those large miners to gobble up the smaller miners. So again, if you're diversified and you're looking to maybe participate in other ways with the advancement of the price of gold, junior miners tend to get gobbled up during these periods of time.
Yeah. And that's a key point about the difference between investing in gold and gold miners. Jan, you've got the gold miners, the GDX, and the junior gold miners. I guess with the key point being, aside from the issue about M&A activity, gold stocks are still stocks, no matter what you say and what anybody says, and they can still be subject to the vagaries of the stock market. I'm just trying to get you to make the distinction between investing in gold and gold mining stocks and how they can be somewhat different sometimes, depending upon even how people are perceiving the stock market in general. Could you just give us 30 seconds on that?
If you want to, gold, put differently, gold bullion is much lower correlation to the rest of your portfolio than gold mining stocks. That's for sure on a day-to-day basis. But if you're in it for total return, the gold miners generally will give you more return. The other thing that would worry me about gold, besides higher interest rates, is signs of a lot of froth in the market. And there have been a lot of inflows, but I will say that from what we see in the gold mining stocks, they're still far from froth. that you've seen in other cycles. We got a long ways to go from what we're seeing.
Yeah. We were talking about limited supply. I'd done a special on gold, a big hour-long special, almost 10 years ago, 9 years ago. And at that time, the World Gold Council had mentioned to me that the total supply of gold ever manufactured would fit into 2 Olympic-sized swimming pools. That's a really good way of indicating how really limited the supply is. Think about this. The total supply of gold ever manufactured on Earth would fit into 2 Olympic-sized swimming pools. So it's really actually a remarkably small quantity. Ben, I think we've got you back here. You've written about gold in the past, and you've noted that the gold does not do well in periods when the dollar is strong, and yet this year the dollar's been fairly weak, and gold's outperformed. Any thoughts on that, or is the dollar only a peripheral in this particular circumstance?
No, I think actually if the dollar continues to fall, it could juice gold returns. So I looked at over the last 50 years or so, half of the years roughly the dollar increases, half of them it decreases. When the dollar rose, the average return for an annual return in gold was a loss of about 1%. And in the years when the dollar fell, gold was actually up around 18% for a year. So that is a really good dollar hedge. So we have these things like, you track real interest rates and inflation and all these things, but gold is actually a really good hedge against the falling U.S. dollar. So if the dollar continued to fall,
so your point is there's there's a very good correlation between the dollar and gold inversely. When the dollar is weak, gold tends to be strong. That was your point, right?
Correct. Yep.
Okay. I want to move on here and talk a little bit about coronavirus and ETFs a little bit. One thing that's very striking is about how well Europe's doing right now. Tom, you were talking about this. We were talking about this at the end of last week. The Nordic countries are doing really well right now. I don't know if this is entirely because of what's going on with a relatively good situation regarding coronavirus here, but you see the Denmark and ETF up nicely this year. The Nordic ETFs, which is a combination of several countries, all up nicely. Vanguard Europe, which is the broad ETF there for Europe, generally is on the downside. But remember, that includes a lot of Southern European countries that have had a tougher time with things. Tom, could you comment on this? What, if anything, is this ETF activity telling us, and does it relate it at all to coronavirus?
Well, I think there has to be some relation, Bob. When you look at single country ETFs, it tends to be, when you take Europe, for example, those areas like Italy are not doing well with the coronavirus, and their markets aren't doing well. Contrast, Northern Europe, the Nordic regions are actually doing really well. Now, you can lift up the hood and you can see that they have certain sectors that they're overweight. For example, healthcare, industrial materials. In Denmark, which is the majority of that iShares Denmark ETF, EDEN. So you would definitely be able to argue, well, they're not diversified as far as in certain sectors. However, if you look at the Global X Nordic ETF, a bigger sample of the Nordic regions, and actually their banks are doing much better than banks are doing here in the U.S. So something to take into consideration. And I know we also want to touch on China as well, because like it or not, China's done a great job in tackling the virus lately. And there's been a lot of encouragement among the local media in China for investors locally to buy stocks. And that's rewarded the Chinese stock market in a great way, too.
And Jan, I know you run a China ETF, CNXT there, and that's also done well year to date. Is it fair to say that part of the reason it's done a lot better is because a somewhat better outcome than expected, or at least so far, on COVID? Is that a fair observation, or are there other reasons?
No, I think absolutely. I mean, it's really amazing how well China is doing. All the other issues aside, economically, what I like to point out is that the central bank has actually allowed interest rates to rise there over the last couple of months, which means that they're so confident in their economic recovery that they just don't feel like they need to be doing a ton more stimulus. So it's just a sign. The whole thing could be a head fake, but China seems to be growing. I love what I call Dr. Copper, which is copper prices. as an indicator of economic growth globally. And copper is higher than it was before we went into this coronavirus recession.
Yeah.
So I think that's another sign that actually the global economy is doing pretty well.
Yeah. Ben, you're going to get the final word here on coronavirus. We're about 90% through the earnings season for the second quarter, and the amazing thing that I've seen is companies are beating by much wider estimates than anybody anticipated, 22% above expectations, according to Refinitiv. I think the obvious conclusion is analysts have been a little too pessimistic about what the numbers are going to be, and the third quarter numbers seem to be rising as well. Can you just give me 20 or 30 seconds of where you feel we are in the stock market in terms of how it's interpreting the coronavirus epidemic? Does it have it right, or is it, as a lot of people say, a little disconnected from reality?
I mean, I think the stock market has been ahead of the game in terms of finding the fact that the jobs market bottomed and a lot of these things have started to come back. So I think it's hard to say whether it's gotten too far ahead of itself, but I think the stock market has been maybe smarter than people give it credit for. But if you look at countries like Germany and South Korea and Australia, who have also done better than the U.S. in the crisis, if you look from the bottom when stocks bottomed on March 23rd, those stock markets are up 60, 70% in some cases versus a 50% gain for the S&P. So I think some of these countries who have handled it better are actually seeing some benefits in the stock markets.
Yeah, I would agree with that. The stock market is definitely grading countries and sectors by how well they've been responding or being impacted by COVID. I definitely agree with that. Thanks, everybody here. Really appreciate all that. We have the best people on, the best people in the business here on ETF Edge. That does it for this week's ETF Edge, indeed. And my thanks to Tom and to Jan, of course, and to Ben. As always, you can view all of our videos right on our website, etfedge.cnbc.com. And don't forget our podcast, where we go into a little more in-depth discussion this week, a little more on gold. I'll comment on that. And thanks, everybody. We'll see you next week, same time, same place.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.